TheoTrade. This is Don Kaufman. September 30th, 2022. 17 minutes to go to the cash close here on this Friday afternoon. SPU's off another 34 handles. It's ugly out there, people. S&P is selling off throughout the course of the week, which has actually brought us the big question that everybody's asking. Can markets back the Fed into a corner? We're going to answer that and much more here on this weekend's update. As I was saying, about 17 minutes to go to the cash close, and I have to tell you, it's ugly. We are literally pretty much riding on the absolute lows of the year. Again, not exactly a exciting thing to talk about here into a weekend update, but the absolute lows of the year were 36.13 even. We just saw a print moments ago at 36.13.50. The assumption, at least from my point of view, volatility futures are kind of amped up here into the cash close. Yet this could turn into a proverbial crap fest, again, with just about 15 minutes left in the marketplace. We're going to push that aside for just 1 second, though, and just get a feel for markets overall. To do that, first, I'm going to cruise into the SPX, the mother of all products. I'm going to zoom into just this week of trade. So for those of you, to give you kind of orientation of what you're presently looking at, this happens to be the SPX and the expected move for the week. And I'm actually going to box this in right here. Okay, what you're looking at is approximately, all right, as I said, the expected move. You're looking for this $123 move effectively higher or $123 move lower. Where are we right now? A little over halfway home to the lower edge of the expected move. But it is notable. This is the first time, okay, after weeks of cracking outside the expected move, it's the first time we're actually inside of the expected move. And I'm actually going to discuss that to some extent here momentarily. Nevertheless, S&Ps, they started the week out right around that 36.90 handle. We're just about 90 handles lower on the week. So I can't say it's like a devastating week like we've had in, well, if you take a quick glance here in a larger time frame, you've got 1, 2, 3 down weeks in a row, but the previous 2 weeks were absolutely horrendous to the downside, like 2 times the expected move. So from a statistical point of view, right now, we're just kind of bleeding out a little bit to the downside. However, as we're going to discuss here in just a moment, volatility is not positioned well. Like, this is not a favorable positioning of volatility, which again, I'll exploit here in just a moment. So I did want to show you something very interesting inside of the S&Ps. And if you do take a look at the S&Ps, as I said, we're kind of butting up again some of the recent lows. And if you look at the S&Ps literally down to a 1 day, 1 minute, we look like we're just going to smash through that. But even more important and more appropriately, let's go to a 30-day 1 hour. And why am I looking at this? Take a look at this entire week of trade. All we're doing throughout the course of this week, and this is really kind of stemming from last Friday. That's last Friday's trade to, well, effectively right now. We're inside of what appears to be a little bit of a volatility box. The upper edge of this volatility box is somewhere around 37.20, maybe 37.30. The lower edge of the volatility box, we're basically sitting on it right now, which is somewhere in the neighborhood here of this 36.20. You got about a 100-point volatility box. And what is interesting about it is we're coming right into the cash close here on this Friday, and we're sitting at the lower edge of it, and we may actually just go for it and break down over here. That would actually be pretty considerable concern, obviously, coming into a weekend, if you will, at the absolute lows of a marketplace. Like, nobody is warm and fuzzy when you close at like absolute lows. Now, you can make the argument, of course, that, well, we've done that week in and week out. Yeah, but here, the positioning, as I'll show you in a moment, in volatility is not a positive thing. So once again, S&Ps are down just about 1%. Nasdaq is down about 1%. Let's move on. Okay, this week, there was a major change of pace in literally global markets. And this is something that's not exactly the easiest thing to denote per se on a chart, but I'm just going to talk you through it a little bit. All right, the Bank of England, all right, broke. Okay, what does that effectively mean? Bank of England had to turn around and actually support their bond market. So for that, we're going to cruise over to the bonds. All right. If you look right now, okay, this is the 30-year U.S. Treasury bond futures. Okay, they have been on a very consistent slide to the downside. Imagine that the Fed had to come in here, okay, and buy them. The Fed actually had to buy them. They're actually putting a floor under the bond market. Well, that's precisely what has transpired specifically over in the UK. So they supported the bond market in the UK, and that actually changed the course of trade quite dramatically throughout the course of the week. And if you take a quick glance, we're actually going to cruise over to the British pound. You can see that in effort to support their bond market, they also turned around and had supported their currency, which from this point forward, and again, I'm going to talk extensively about dollar and bonds. I do believe that the US dollar right now is out of the contest, meaning that the dollar does not have to rally at this point for S&Ps to sell off, because you can immediately make the argument, look, okay, yesterday was significant sell side activity inside of the US dollar. What did the S&Ps do? Fairly dramatic down day. We didn't finish at the lows yesterday. S&Ps though were still excuse me, we're still down about 80 handles yesterday. So we're having a down day coupled, okay, with a hideous, if you will, down day inside of the US dollar. So it does appear from this point forward. And again, what I'm trying to do here into answering this question, can markets back the Fed into a corner? First, I want you to see what has occurred with the Bank of England, which is not necessarily all that significant. If this was the European Central Bank, obviously, if this was a Fed, things would be dramatically different, right? But this is the UK. They turn around and they actually caused what was probably one of the trades that everybody was looking at. It's like, hey, by the way, we just broke into lows here. So, the UK turned around, started buying their bonds, and they caused the trade that everybody was looking at, the dollar, to no longer become, well, the trade of choice. And again, when something changes in this marketplace, you got to be on it. You got to be Johnny on the spot right now, because this is volatility. The other aspect, so they've taken the dollar rally out of the equation. At this point, in my opinion, the dollar does not have to rally, and the S&Ps can still get absolutely crushed. So the Bank of England absolutely broke. And again, they broke because of, you can argue policy mistakes, you can argue tax cuts. It doesn't matter. All right. Bottom line is we now have a central bank that's coming in and effectively doing a version of quantitative easing in a time when everybody's raising interest rates. So imagine with one hand, you're like, yeah, we're going to fight inflation. We're going to do it. With the other hand, you're actually buying your own bond market. Got to love this. It's like the inverse of what we call the twist program. The twist program is about a decade ago, where the Fed went in and was actually supporting the longer term bonds, okay, and selling shorter term paper, buying longer term paper, and actually twisting, if you will, the entire yield curve. Anyway, onward and upward from there. So the Bank of England broke. Question is, who's next? On that front, we have here in the US inflation versus the Fed. And one of the things that happened and transpired today, and I'll actually show you some of the trade from early this morning, okay, right here. And I know this doesn't look like all that much on the screen, but right here, we're trading this morning at 36.75. And PCE data came out, and it came out extremely hot. For those of you who have no idea what PCE data is, it's, if you will, it's our Fed's inflation indicator of choice. Those are not my words. That's actually the Jerome Powell words. We traded from 75 basically down to 40, so it's a 35 handle move inside of 1 minute. Now, granted, we've seen bigger moves before, but this inflation data came in hot. And then there was a number of speeches that came out from the Fed vice chairperson, and it was, again, it was all about Fed versus inflation. They're not going to back down. They're going to be persistent for a long period of time, yada, 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 okay? I'm going to tell you at this point in time, you really do have to be concerned, because what the market has seen in the Bank of England, that is coming to a theater near you. All right, the entire discussion at this point needs to surround, obviously, the S&P 500, okay? And what I'm trying to position here is when I say, can markets really, back the Fed into a corner? More specifically, are the markets actually going to break the back of the Fed? Now, I think there's two fronts that you want to watch this on. Number one, S&P 500. Some dramatic sell-side activity inside of the S&P 500. If that were to occur inside of the next couple of weeks, would the Fed actually reverse pace? Would they start using different rhetoric? Even if they're going to continue to raise interest rates, are they actually going to change a little bit of their tone and back things down a little bit? And that would take, I believe, a dramatic and precipitous drop inside of the S&Ps. You have to be extraordinarily concerned about this at this point in time. Why? Because one market already broke. Okay, they could actually start snapping like dominoes. And here in the U.S., one of two markets could actually break the back of the Fed. One could be the S&Ps. The S&Ps, when I say a precipitous drop, we're talking 300-400 points out of the S&Ps in a short period of time may actually cause the Fed not necessarily to pivot, but some of the verbiage, if you will, to change where things economically are getting a little bit out of hand. But nevertheless, you really want to be concerned right now with the S&P 500, okay? Because the S&P 500 does appear that it's figured this tone out of the Fed, that the Fed's not going to back down. So you're actually going to see, I believe, that the S&Ps are going to play a wild game of chicken with the Fed. That is going to bring on even more volatility. Like, listen, this is not going to exactly be a wonderful upbeat conversation as the S&Ps are actually closing in on their lows with 5 minutes to go in the trading week. So if you will, I want to bring that to your attention again. S&Ps tank, okay? Actually breaks the back of the Fed. The Fed has to come in and actually change some of their verbiage to ultimately save markets, right? That's actually one plausible scenario. Another plausible scenario could be out of the bond market. The bond market does not have to continue to go to the downside. However, okay, if bonds started to spiral out of control to the downside, unequivocally, something is going to have to be done. Okay, again, they could actually change pace. But there's actually one other scenario in here that I've actually game planned out, and that is you could actually see the S&P 500 sell off and flood capital into the bond market. Again, still, that would cause the Fed ultimately to break. It is going to be an absolutely wild time. And again, all of this is interlinked. The Bank of England broke. Inflation versus the Fed, like inflation indicators came in. As I said, the PCE indicator came in, I believe it was 4.9%. It was 4.7% expected. We're going to get more inflationary data out possibly this next week. You're going to start to break the back of the central banks. Like, are they going to get their policy through? Meaning that everything's about inflation right now, but we must adhere to and stop inflation at any cost. Yeah, except the fact of the matter is, at any cost means, well, you're killing markets. And again, as I said, we were poised to do this, and here it is. Okay, this is total like blitzkrieg, if you will, into the cash close. This is not good. There's a huge amount of gamma risk sitting in this marketplace. You could even see more sell side activity. It doesn't matter that there's 3 minutes left in the trading day. And again, if you're selling premium out there, okay, things get a little bit scary at this point. All right. So with that, as I was saying, breaking the back of the central banks, dollar again is out of the contest. I really like, if I saw the dollar starting to break to the upside, I would definitely have some cause for concern. But the most critical aspect of this is that the dollar does not have to break to the upside, in my opinion, for the S&Ps to continue to go lower. The same is true of bonds. Bonds have kind of been a little bit taken out of the equation. We could see a situation where the S&Ps sell off so violently that we start to rotate capital back into the bonds because there's just no saving grace anywhere. Like, where are you going to run to? Where are you going to hide? In fact, you can see volatility. Speaking of where to run to, where to hide, volatility actually right to the highs of the session, which actually brings me to, well, my next point here in this weekend's update. Take a look at volatility positioning. You can't like this at all. Volatility is positioned right towards the high end of its range on a 9-month. But wait, there's much more on this front. I can open up a max chart on volatility going all the way back to the 1990s. That's like, crash in 1987. Let's tighten this up a little bit. Let's come back to more recent times. Now, they changed the way that the VIX was calculated, yada, yada, all the way back in 2014, but neither here nor there. What I want to point out, if I just leave my little mouse on the screen right now, and again, we're coming into the cash close, but I draw a line against it. You can pretty much count on one hand the number of occurrences of volatility, okay, at this level or above. And there have not been that many occurrences of volatility above this level, okay? And pretty much every single time that we saw volatility up here in the 30s, we spiked. you have to be extraordinarily careful because this is the level, all right? This is the inflection point right here, somewhere around that 32, 33 level. We either explode, you could actually have vol into the 40, 50, even 60 range, or we're going to collapse right back down. There is no in between, people, at this level. You actually do your own research in the VIX. On top of it, we're into a wild, just a wild backwardation right now in terms of the volatility futures. Do you realize that, again, it's about 55 cents of backwardation in here? But as you go as far out as 138 days, we're in full-blown backwardation. Okay, what does that entail? The risk is right here, right now. It's on top of us. Okay, so volatility is already positioned for us to rock, if you will, to the downside. And again, my just statement about the the market versus the Fed, can markets break the back of the Fed? Listen, I think markets have actually figured that out, and that's exactly the kind of position that you're starting to see. That's why volatility is probably sitting in this poised range, ready to break to the upside. Speaking of markets, look what's happening to the bonds right now. This is wild because it's exactly what we're talking about here as it's occurring, is that they're selling the S&Ps and all of a sudden turn around and start buying bonds. You're like, this is crazy. Okay, trade is running scared right now, and we're right at that point where the VIX, okay, just we've seen some big rips in the VIX, but from this level higher, it's like a never-ending story to the upside. We start to spiral out of control in terms of volatility. You have to be extraordinarily careful in terms of how you want to position yourself into this, okay? Because right now, the way to only, present this, okay, is you're moving, if you will, into the volatility storm. 7 seconds left in the trading day, and check this out. We are literally at lows. Markets are going to finish. There's the closing bell, and markets are finishing at lows. By the way, I can't stress that enough. 3,600 on the button. Obviously, the S&P futures are open for 15 minutes after the cash close. All right, moving on over here. Last week, I was talking about specific underlyings to be looking at. See, right now in a marketplace like this, you always want to keep focused on the fact that we're in a heavy correlated state. Everything we're doing, we're moving very cohesively, meaning, there's nowhere to run to, nowhere to hide. There's no stocks in the S&P 500 that even matter. People look at this and go, but Baba's up and Twitter's up. For the most part, there's nothing that really matters in the S&P 500. It's just all about the futures contracts. But we're going to look at Apple, okay? And why? Because last week, verbatim, I said, Apple leaves huge risk on the table. And what we're expecting is Apple to get crushed. Take a look. Why? Because Apple was outperforming the S&P 500. I didn't know anything about Apple, and it's possibly going to slow down the building of the iPhone 14. Who cares? It's down 24% now. Okay, where are the S&Ps? They're down about 25%. What a difference a week can make, right? Because again, this 1 week, you've actually had Apple get crushed versus the S&P. Now, what do I want to look at moving forward? Okay, Apple is still unequivocally, outperforming, if you will, the Nasdaq. Nasdaq as a whole is down 33%. That's the QQQ. Qs are at their absolute lows of the year, close at the lows of the year, down about 33%. So Apple could still see some sell side activity, right? But I also want to bring up Tesla. Why do I want to bring up Tesla? So Apple's down, again, I want to reiterate this. Apple is down about 24%. I want to bring up Tesla for the mere fact that Tesla, okay, is down 33%. It's right in line with the S&Ps, but look how far Tesla is off of its recent lows. That's a little disconcerting. The marketplace and CTAs may look at this and say, smoke it! You got to be careful inside of something with Tesla, okay, for bullish positions in the very near future. Next, we actually cruise over to something like, well, Amazon. Okay, it doesn't matter that Amazon's in line. Okay, it doesn't matter that it's in line with the Nasdaq. The fact of the matter is it's still off the lows and markets are at lows, so you have to be a little bit careful. The other thing that really resonates with me in something like Amazon, when you start to open up like a 5-year chart, okay, this thing could have dramatic move to the downside. We are nowhere near, like COVID lows. And I want to bring up like, for instance, Meta. Okay, here, Facebook, this is something that's been beaten and bludgeoned. This is not going to be a leader of the pack, if you will, to the downside. Nevertheless, cruise over again. Now we're going to jump to, for instance, Starbucks. Okay, why am I actually looking at Starbucks? Look at the performance of Starbucks on a year-to-date basis. Only down 27%, but it is considerably off of its lows. Right now, what you have to be concerned about, again, is stocks that are not at the lows of the year. Doesn't even matter so much in the percentage basis. They're going to be looked at, okay, and possibly pummeled. In fact, if you open up even like a 5-year here, anything that's like performing relatively well, 5 or even a 10-year chart, okay, the consideration is look out below. Next in the docket, energy. All right, so I've been fairly critical of energy and I've carried some short positions in energy. I continue, okay, to carry short positions through the XLE in a number of different accounts. In this particular account, I am still down 10% on the XLE position. I will continue to maintain the short position in here. Why? First of all, on a year-to-date basis, the energy sector is still up 25%. So if markets are going to continue their downward spiral, forget about fundamentals for just a second, because I'll just tell you right now, I just don't care. Like I don't care what you think the fundamentals are. There's no fundamental discussion in the fact that if the market figures out that it can slam itself down, right? And if the markets get absolutely crushed and trade gets ahead of it and says, yeah, if we just take off another 400 S&P points, we'll just break the back of the Fed. The Fed will have to reverse policy. We'll get what we want. What do we want? We want free money forever. All they have to do is figure that out, and the XLE is going to get slammed. Okay? Be aware right now, if you are long anything in the energy sector, this is dangerous. It's up 25% year-to-date basis. The other area that I'm actually looking at that's on the dance floor here. Now, again, the XLF, the financials, they are at their lows of the year. But there is a critical level, and I want to show you over 5 years, 2650. Okay, I'll actually bring up a genuine 5-year chart over here, 2650. If people are kind of curious where I think the financials are headed to, it's 2650 level. At that point, and the reason I'm bringing up the financials, okay, is to justify possible bottom for the S&Ps. When the financials get down to 2650, we'll look at the S&Ps as having a possible bottoming formation. This has been a critical threshold in the entire marketplace, is the XLF at 2650. Last but definitely not least, as always, we take a look at the SPX, the mother of all products inside of the SBX. Wow, we came right up to it. We never tagged the lower edge of the expected move, which was right around 3571. We came within a hop, skip, and a jump, though, of that lower edge to show you, okay, if markets were open seconds longer, we'd probably hit the lower edge of that expected move. But again, this is the first week in many, many weeks that we've not hit the upper end or lower edge of the expected move. So last week we had a $123 move. As I said, it kind of feels we're like this crazy volatility channel. What are we projecting? Now, we do not have the definitive expected move yet for this next week. This next week, of course, ends October 7th. We're looking about the same kind of volatility as this week, somewhere in the neighborhood of about $121, $122 expected move. Be mindful of this. So we just passed through was a pretty wicked and volatile week. Each and every day, huge moves from low to high. This next week, about the same kind of movement. Nevertheless, we just came off a week. We had 17 Fed speakers throughout the course of this past week. This coming week, some heavy economic data. I mean, listen, this is just going to be rough times ahead. There's no question, okay, not even a question, that we're in hideously oversold territory, no matter what indicator you want to bring up. But I will constantly and continually remind each and every one of you, markets never crash from highs. They crash off lows. When you start looking at risk reward, okay, there is definitely vicious risk to the upside, but these are the equivalent risk to the downside. It's rare that I do this, but I assign right now pretty much equal weight to upside risk versus downside risk. Obviously, markets could have considerable downside. Volatility is poised right now to break to the upside, causing a kind of out of control spiral, if you will, in the S&Ps. At the exact same time, we just cannot get a bid under us. When we do, we could rip. You can't find a lot of reasons to buy, but you don't need them. People sooner or later are going to come in here and cover their shorts, and we will rip higher. Okay. Prior to that, though, this could be a rough time. These are also the kind of trading sessions where you have to be concerned even overnight. I'm setting alerts each and every night. 40 points higher, 40 points lower. Wake me up in the middle of the night, okay, if those alerts go off. It may sound a little chaotic, a little crazy possibly. Nevertheless, clearly we see risk in this marketplace. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.